Trainers, September 15th is coming fast. For a lot of self-employed people, card sellers, streamers, creators, and business owners, that means an estimated tax payment is due. But what exactly are estimated taxes? Who needs to pay them? And what happens if you skip one? I'm Kyle Johnson with Lavender Town Accounting. Let's break it down so you can stay ahead of the IRS and keep the penalties from landing a critical hit on your tax return. You might be asking, what are estimated taxes? Estimated taxes are simply a way to pay federal income tax as you earn income throughout the year. If you're a W-2 employee, your employer generally withholds taxes from every paycheck. But if you sell Pokemon cards, run a shop, earn income on the circuit, earn creator income, get sponsorships, stream, freelance, or have investment income, nobody's withholding taxes for you. The IRS still wants to get paid throughout the year, so instead of one huge bill at filing time, you may need to make estimated payments. Despite what everyone calls them, they are not equal calendar quarters. For 2026, the federal estimated tax due dates are April 15th, June 15th, September 15th, and January 15th, 2027. The September 15th payment is the third installment. It generally relates to income earned from June through August, not July through September. It catches a lot of trainers off guard. Now, if 2026 is your first year being self-employed, first off, congratulations. Also, this may all feel brand new, and that is completely normal. Maybe you started selling cards regularly, began earning income from YouTube or Twitch, or both, competed and earned income at multiple regionals, or turned a hobby into a real business. The big change is that no employer may be withholding taxes for you anymore. Each time money comes in, remember, it's not all yours to spend. You may owe federal income, self-employment taxes, and possibly state income taxes too. A simple starting point is to set aside a percentage of each payment in a separate savings account. The right percentage depends on your income, deductions, and filing status and state, but setting money aside from day one is much easier than scrambling in April. A rule of thumb I like to use is 30% of your net income should be set aside for federal, state, and potentially local taxes. Again, each trainer's tax situation is unique, so this is general advice. Here's an important detail. Being new to self-employment does not automatically mean you cannot use last year's tax return for your safe harbor. If you filed a qualifying 2025 return, that number may still help guide your 2026 payments, even if you had no business income last year. If last year's tax was zero, or you did not file a prior year tax return, you will generally need to estimate your income based on the current year's income. Generally, estimated payments come into play if you expect to owe at least $1,000 for the current year after subtracting withholding and refundable credits. That could apply if you bought and resold collections, had a great competitive season, started monetizing YouTube, or your side hustle evolved to a real business. Here's the important part. You do not need to perfectly predict your final tax bill to avoid underpayment penalties. There's something called the safe harbor rule. You can generally avoid the penalty if your withholdings and estimated payments add up to at least 90% of your current year total tax, or 100% of the total tax shown on your prior year tax return, whichever amount is smaller. If your prior year adjusted gross income was over $150,000, that prior year safe harbor now becomes 110%. Let's use an example. Say Lance had $12,000 of total federal tax on last year's return. If he's not sure exactly what his 2026 tax will be, he may generally use the prior year method to pay in $12,000 over the year through withholdings or estimated tax payments. That does not mean he'll owe $12,000 if he has a huge year. He'll still pay the difference when he files, but following a safe harbor can help him avoid the underpayment estimated tax payment penalty. The underpayment penalty is a key thing to understand. It's generally not one giant punishment at tax time. The IRS looks at each payment period separately and may charge interest and penalties when you do not pay enough or soon enough. Waiting until April to pay your full tax bill may still leave you with some penalties, even if you pay every dollar you owe with your return. If your income is inconsistent, maybe you had a huge card show in August, sold a high value collection, landed a summer sponsorship, or even won Worlds at the end of August, the annualized income installment method may help. It lets you base your payments more closely on when you actually earn the income. But it does require more record keeping. Here's the practical game plan. Estimate your income and withholding using Form 1040 ES. I'll put a link to it in the description below. Compare that number to last year's total tax and make your September 15th payment and keep records of every payment. Remember, estimated payments are not an extra tax. They are prepayments that get credited to your tax return. If you'd rather not figure out your estimated taxes alone, visit lavendertownaccounting.com to learn how we can help you build a tax plan that fits your needs. You'll also find free resources and can learn more about Lavender Town Accounting. The big takeaway: if you have income without enough withholding, September 15th matters. Don't let a strong earnings season turn into an unexpected IRS battle. If this helped, like and subscribe for more Pokemon business and tax tips. And comment below. Do you make estimated tax payments, or is this the first time you've heard of them? At Lavender Town Accounting, we're here to help you count them all and keep it all. Legally, of course. See you next time.